Good morning, everyone. Hope you're all doing very well. Welcome to another Morning Money Conversation with Stephen and Drew. And welcome to the first day of summer if you're in the Toronto area. I know most of us here are pretty excited. We've had a pretty decent winter. I think I've seen snowfall probably 2 times this entire year. Um, but I'm not going to unclasp my fingers as yet because I've also seen snow in May. So enjoy it and let's make the best of it. So for those of you who are new, this is I think, our third conversation where Steph and Drew speak about two very innovative financial products that many have some misconceptions about. One is the infinite banking concept, which is offered to insurance companies, and the other is a reverse mortgage or a home equity release, something that has so much confusion. But before we go any further, I would like to give you a bit of background on these two gentlemen who are going to present to us today. First, let's meet Andrew Short, who is the heart and mind behind DF Insurance Solutions, where cutting-edge life insurance and health insurance meets the needs of families, professionals, and small businesses across Ontario. With a rich experience spanning over 15 years, Andrew has become a cornerstone in the life and health insurance landscape, known for his trustworthiness and deep industry knowledge. But he's more than just an insurance expert. He's a dedicated family man and a pillar in his community, mentoring young men and sharing his insights as a contributing writer for the Toronto Caribbean newspapers. His educational background and client service skills shine through in his ability to craft bespoke insurance solutions, adept in both traditional and virtual settings. What sets Andrew apart is his understanding of life's various milestones, from buying that first home to planning for a child's education or navigating the complexities of health protection. He believes in creating personalized plans through ongoing relationships and regular interviews, aligning them with his clients' evolving goals. At his core, Andrew is a guide, an educator committed to empowering others through knowledge. He's not just providing insurance, he's offering peace of mind and a path to a secure future. Stefan is a level 2 mortgage agent and has been licensed since 2017. His journey to becoming a successful agent in the industry is not an overnight story. His father, who is myself, he's my eldest son, is a veteran in the mortgage profession with over 25 years of industry experience. The office, which is in Meadowvale area of Mississauga, is where an adolescent Stefan, and even at a younger age, spent a lot of his time. And being naturally observant of his surroundings, he soaked in the mortgage broker environment during his regular visits to the office. Stefan has managed to move the family mortgage legacy to new heights with accolades including the top producer awards every year since 2018, as well as the 2020 CMP Rising Star, which is the Canadian Mortgage Professional Rising Star recognition for achievement. He has an uncanny ability to analyze each client's situation and to simplify a tailored solution so that they may reach their individual mortgage needs and financial goals. During his time away from the office, Stefan enjoys cycling around his neighborhood. He's also a connoisseur of exclusive collectible items and enjoys spending time with family and close friends, and is also a well-traveled young man. He does a lot of traveling. Ray McMillan, I am the facilitator. I have spent about 30 years in the financial services sector. 25 of those years as an independent mortgage producer. I am recently retired from the mortgage space and currently looking at other opportunities throughout North America and the Caribbean. So let me open the floor to my Steph and Drew this morning. A bit of housekeeping rules. Please make sure you keep your microphones on mute. Any questions you have, you can put them in the chat. And at the end of the presentation, I will present those questions to Stefan and Andrew. and then they can provide you with their answers. So gentlemen, the floor is all yours.
Thanks, Dad. I appreciate that introduction. I'll start off the presentation. Again, thank you everyone for attending the Morning Money conversation. Just gonna share my screen and we'll start the presentation. Just give me a thumbs up if you can see my screen. Someone just, all right, thank you, Dr.
Yes, we
Lai.
can see the screen, Stefan.
Thank you. So I'm going to start with the first case study. This case study I enjoy sharing with the audience because it was my first home equity release case study, and it has a lot to do with various ways that people have misconceptions about a reverse mortgage, also called a home equity release. So I'm going to start off with the story with Greg and Mary. Their names have been changed for privacy purposes. So Greg and Mary are a married couple. They're retired and they live and they're in their 80s, and they lived in the Ontario cottage country. Their monthly mortgage payments and personal debts were eating away their fixed pension income, Canada Pension Plan, old age security, and employer pension. Give me 1 second. Someone said expanded. Sorry, bear with me. I'm just trying to expand it. Yeah, so I was saying the monthly mortgage payments and personal debts were eating away at their fixed pension income, the Canada Pension Plan, old age security, and employer pension. This is a common case with most retirees. They have a fixed pension income. The cost of living is eating away a lot of their pension income, and they also still have a sizable mortgage that they have to pay monthly. So this was one of the concerns the clients had with me when they came to me at first. Again, reverse mortgage was not the first thing I suggested towards them. Most clients are familiar with a traditional mortgage, HELOCs, those type of mortgage products. So when we went through the kind of the list of things that they couldn't qualify in a traditional mortgage sense, I provided that solution of a reverse mortgage. And when I provided that solution to them, they were hesitant. That's the natural instinct when you hear something like a reverse mortgage with no mortgage payment, my equity is increasing. So they had some concerns. And I'll go with the first question that they had that was concerning them. Does the bank own my property? Well, they don't own your property. You always remain under title. In that case, there's no change of title. You always remain in your home and you own the home. The next question was, what happens when one of us passes away? When one passes away, the mortgage loan is not requested to be paid in full until the last survivor passes away. In this case, during the pandemic, one of the spouses did pass away, and the lender just wanted an updated home insurance policy to reflect that information. Unlike a traditional mortgage where a spouse or applicant does pass away, they may strongly ask for a new appraisal or income documents to see that you still can afford this mortgage. In this case, with the reverse mortgage, they just wanted a home insurance, updated home insurance to show the correct information. Ending this was a home equity solution. I was explaining to them that the home equity mortgage amount is based on certain factors such as age, property type, and property value. and I quickly run a financial illustration showing that the home equity value may increase to offset the interest accumulated. And I also invited their children to be part of the conversation to set up a meeting with the lender to answer all questions in a group. In this case, the clients were referred to us by a longtime clients, their children, or their daughter in this case. And she was part of the conversation throughout the whole process. And one thing when you're dealing with a home equity release, you're dealing with a certain age demographic, and you want to be mindful of how you explain the product tremendously and have their children involved as well, because ultimately it does involve real estate planning, estate planning, for the children. So you like to involve two parties into this conversation, so both parties understand what they're getting into when it comes to a reverse mortgage. And that's my first case study, all season cottage.
Thank you very much, Stefan. That was a very interesting scenario. What was the pushback from the children, if any? Like, did they have any objections to the? Because I know that the Mass, you see the questions here. I know that the reverse mortgage or home release is still a very misunderstood product, as I said earlier. So, what pushback, if any, did the children give?
Yeah, the pushback the children had was a common kind of hesitant with the product, is where they find that they may not have any equity left over. And that's not the case here, because the reverse mortgage only goes to 55% of the appraised value. And with the financial illustration I was sharing, we show a chart of the year span of the term of the mortgage or your lifespan, the appraised value going up every year or so, while the balance you borrowed is increasing with interest, but you are left over with a substantial amount of equity. And that was the concern, with one of the concerns that the children had, and also that the parents wouldn't own the property as well. That's another big concern with a reverse mortgage.
Another question for you. If you don't mind sharing with the audience, how old were the couple when they first took out their reverse mortgage?
They were both, the wife was 84 and the husband was 85.
Okay. So would you say that the product is better suited for elderly clients who are probably over the age of 75 as opposed to, because I know the product starts at age 55 and above, but in your experience, having done a few of these transactions, do you think the product is better suited for individuals who are over the age of 75 as opposed to those who are below the age of 70 or over the age of 70 than those who are younger?
Yeah, that's a great question. It is geared towards people actually over 80. 75 is a good sweet spot, but if you're over 80, you're able to maximize up to 55% based on your age. When you're below 70, the loan to value gets kind of reconfigured based on the property type, your age, and the property value. But once you're over 80, you can go up to 55% of the appraised value.
Okay, so the younger you are, the less funds you're able to access under this product.
That's correct.
Okay. Now, what qualification do you need? Do the lender need any sort of income documentation? Is your credit score important? That sort of stuff, like a traditional mortgage?
Credit score is not entirely important, meaning that they don't look at credit score. However, if you have some type of delinquencies, bankruptcies, then that's a concern. If you have small collections, in this case, they'd had a small Rogers collection, that's not a concern. It will be paid from the proceeds. When it comes to income documentation, they just need sometimes case by case. If the person is below 70, they may just want a verbal, no income provided, just a verbal saying that they worked at this previous employer if they're retired. If they're still employed, they just want to see 2 years notice assessment showing no income taxes owing.
Okay, perfect. So it sounds like a pretty decent product for our aging population here in Canada, particularly as mortgage rates have continued to rise and many people can't afford their homes at the current at the higher rates today. Okay, so did you want to do your next case study now, or did you want Andrew to do his own first and then come back to you? That way the clients can get an insight,
Yeah,
or audience get an insight into what
yes.
the in-flight banking concept is all about.
Yeah, I'll just unshare my screen and let Andrew take the lead.
All right, thanks for that. Andrew?
Thank you, Ray. Thank you, Stefan. That was informative as always. Every time I hear you, I pick up something new on the reverse mortgage product. So thank you again for sharing that. Once again, I want to thank everybody again for joining our Money Morning Conversations. This is our third one. And just to recap on the last session that we had, I just went into explaining what the infinite banking concept was, what it can do, and Ray asked some questions on who it's for, and how it's actually funded, and who provides this type of plan. But today I'm going to share with you a case study, and because it's the infinite banking concept, the whole point is to take the money that you either currently have saved or saving, and making a decision on where do you want that money to be stored for you. Do you want it to be in the traditional bank? Do you want it to be in the traditional investment programs such as the RRSP or tax-free savings account? But the infinite banking concept gives you another alternative. It shows you how, if you save your money in a participating whole life insurance product, how that can unfold for you for not just one financial milestone, but multiple financial milestones. So today I'm just going to bring you on a journey of a couple who were looking at saving their money or using their home equity to start funding a policy with the purpose of preparing for retirement. So I'm just going to bring up the case study. So just give me 1 second. So the couple's names is the Johnsons. And like I was referring to before, their main issue or their main worry at this particular point was, what is the money that they currently have and the assets that they currently have? How are they going to start utilizing that in their retirement years? So just to give you some background information, John and Mary Johnson. Now, John, he's age 52. And Mary, she's 50. So they're close in age, which is good. Now, John, he's an engineer, and Mary was currently a school teacher. The combined annual income for both of them was $150,000. Now, at this point, their children have already grown up, have left the home, and they were able to have a currently savings of $50,000, and this was in a tax-free savings account. Now, the good thing is that the Johnsons they did things right. They kept their expenses low and they kept their debts even lower. So they had no outstanding debts. They were able to pay off any car loans, didn't have any credit cards. So most of their monthly expenses was paid through whatever income they were earning, which was lessening how much they had to pay out to other financial institutions. Now, the good thing about the Johnsons as well is that their home value at that particular point was $800,000 and was fully paid off. So there was no mortgage. Now, the current financial strategy and their situation was they were going to they focused on John's RSP contributions and his pension. Mary's income mainly went towards the savings, and John's income mainly went to making sure that the household was running in an efficient financial manner. Now, they did currently have a $250,000 term life insurance policy. So again, their plan is to retire at age 65 with a stable income. They also knew that there was a life insurance component need to this because one, they wanted to provide an estate to their children, and two, pay off any taxes that would be owing on John's RSPs, and they did have a joint RSP for Mary as well. So going into the infinite banking solution. So because they were looking at what could be the biggest issue to them having this type of plan. And the biggest issue was the funding of it. So they didn't want to use John's income or use any of the savings that they currently have because they wanted to keep that as an emergency. So because their home was fully paid off, we looked at the option of tapping into their equity. Now, they were comfortable with tapping into $150,000 of that equity to fund their policy over a 10-year span. So when we looked at the numbers, we agreed, okay, we can take out $15,000 a year as a premium deposit into their plan for 10 years. Now, they would access that equity by using a line of credit, and they would then fund their policy using that line of credit payment each year. Now, when we looked at the values of what that would help them do, at age 61, the cash value was at over 163,000, with a permanent life insurance benefit at 446,000. Now, at age 70, that total cash value would have grown to 279,000. If they were able to now start withdrawing from their policy, they were able to withdraw $20,000 per year until the age of 85. So they put in 150,000 and they were able to withdraw 300,000 up until the age of 85, but they could have gone on further. They just wanted to see, okay, till the age expectancy, what would that look like until age 85? So the premise of the infinite banking concept is the reason why it works is because while your deposits are being put into your whole life insurance policy, you're also receiving guaranteed interest and dividends from the insurance company's profits. And they share those profits with you, the policyholders, and that gets reinvested back into your contract. So this is just a quick case study of how an insurance policy can not only provide a retirement income stream in your retirement years, but also have fully paid up death benefit to provide to your heirs to create generational wealth and pay any estate taxes that you may have.
Thank you very much, Andrew. That's a great presentation as usual. Are there any questions from the audience? Is there anyone who needs any clarification on the way the internet banking concept works? I've got a lot of questions, but I just wanted to know if the audience has any questions before I start asking my questions. You can just type your question into the chat, and I will read it out on your behalf. If you want to remain anonymous, that's not an issue. I will not mention the name. But if you don't care to remain anonymous, then I can mention your name. I don't see any questions as yet. Let me ask a question though, Andrew. You said that the interest is guaranteed. Now, I know it comes to investing, guarantees are always a sweetener when it comes to people who have a low risk tolerance or are completely risk averse. What type of rate guarantee does the insurance company offer on the investable asset?
So that's a great question, Wei. So the way that the insurance contract is written is as long as you, the contract holder and owner, make your premium deposits each year, the insurance company is writing into the contract that your cash value growth will increase by a guaranteed interest rate. Now, that interest rate can can change. Right now, it's currently at 5.5%. With some carriers, it could be lower. It could be a little bit higher. But it's written in black and white that no matter what, whether they make money or not, you're going to be guaranteed that interest.
So is that interest rate changeable during the period of the contract, or whatever it is at the beginning of the contract is what it will be for the entire contract?
So it's changeable each year.
Okay.
So they disclose that interest rate to their participating holders, contract holders. And it's been consistent now for the last, I'm going to say over 10 years that rate hasn't changed. So they're not in the business of changing rates like the banks, because they know that this is going to be in your contract. It's in the illustration. So they pretty much hold that steady.
Okay. So it's fair to say then that in an environment where mortgage rates are rising and the cost of borrowing is costly, and in the investment market, the stock market has a level of uncertainty, that an insurance product provides much more security, particularly for someone who is starting to invest later in life. Would that be an accurate statement?
That's a very accurate statement. In fact, it's probably the safest type of environment outside of a GIC, where you have less accessibility to your money in a GIC, where this is going to be just as secure as a GIC, because the money that you're depositing into your contract is not invested into the markets. The insurance companies do not invest your funds into the stock market, and it does not follow the up and down trends that you would have in market risks.
Okay. Now, I know you're not an accountant, so I expect that the audience, if they need accountant advice, they go speak to an accountant. But what are the tax implications at death of the first spouse, second spouse, and the funds going to the estate? Like, what can the estate anticipate in terms of probate tax? I mean, taxes based on the size of the asset.
So the way that the taxes work is you can pretty much call it a tax-free vehicle, okay, on both fronts. On both fronts, on withdrawing the funds from your plan, because you're withdrawing them from your plan, you can either do it as a withdrawal, which is you just selling back the insurance units back to the insurance company, so it's not considered income. So that would be tax-free income as well. Or you can do it as a policy loan. A policy loan is you basically leveraging against the death benefit. Again, because loans are not taxable income, that would be tax-free income to you as well. So in this particular case, they were able to take out that $20K per year and not have it affect their income earned in retirement years if they were getting CPP or OIS or any other government retirement income that could be reduced if your income goes over a certain amount. Now, the best part of it is because of the death benefit, that is also tax-free. So when they were to pass away, either if it was a first to die policy, meaning that if the first person passes away, the death benefit gets paid out to the beneficiaries, that would be tax-free. Again, if it was a last to die, meaning that the last person passes away, then again, that gets paid out to either their children or their estate, tax-free.
That's very interesting. Let me ask you a question. This is a bit of a personal question. What percentage of your client portfolio has this kind of product?
So currently, I would say that a good 25% of my client base has permanent insurance in place. Now, the concept itself of how to actually use the policy on a regular basis, not just letting it sit and wait for you to die, of really starting to learn how to access the cash value, how to use it to pay off debts, how to use it to go on vacations, that's been increasing. So when people start seeing the power of what this policy can be done, not just only in death, but in living, that's been growing tremendously.
Okay, yeah. Thank you very much. Thank you very much. So we're now going to shift back to Stefan. I think he has another case study. As I said, if you have any questions, feel free to put those in the chat, and both Steph and Drew will answer those questions for you. So Stefan, I think you have to share your screen. to get back to your second case study. Steph is presenting on the reverse mortgage product, or what is called a home equity release. It's a relatively misunderstood product. And Stefan, who has got quite a bit of experience in doing reverse mortgages, is here to bring some clarity to the product and application or applicability of the product to individuals who are homeowners and need access to cash. Go ahead, Steph.
Thanks, Ed. Yes, this is my second case study. I like to do various different case studies because the reverse mortgage is a product that can be used in various scenarios. And you'll see in this scenario is very much different than case study number one, which is very a vanilla type of a reverse mortgage. So I'm going to start off with case study number two. Again, the names are changed for privacy purposes. So this is Karen and Carrie's story. They're both sisters. Karen's is the age of 65, and her sister Carrie is the age of 68 years old. And they own a single family home in the GTA. They had that home for over 40 years, and it needed quite some uplifting work to be done. It's a house that's been lived in. In most cases, like I said, house has been lived in for 40 years. Many people don't have the funds to do any type of major renovations unless they unlock the equity in their home. And, you know, in the cases where our clients, some of them don't have any type of RSPs or CAT savings, this is maybe one of the best routes to take when it comes to taking out equity. So in this case, they wanted to do some major construction costs to their owner-occupied property. The construction costs estimated around $140,000. Additionally, to paying off some overdue property tax bill. With the reverse mortgage, they do pay off over property tax bills that are in arrears. And again, this kind of highlights where a client is overdue on their property tax bill really stimulates to being a fixed income or lack of income, in this sense, so to speak. So in this case, Carrie, she's a retired nurse and she has a pension income. So she has CPP and a pension plan, old age security, and a nursing pension. Karen, on the other hand, the younger sister, she's actually a practicing lawyer in the Caribbean. So they came to me from a referral partner, and they didn't wish to have a traditional mortgage payment obligation to add on to the increased mortgage from the construction costs. So for me, that was an opening to share how the reverse mortgage can leverage that construction cost for them without having a monthly mortgage payment obligation. So they were all ears when they heard about that. So the question one was for them is that, can they qualify for a reverse mortgage on foreign self-employed income? Again, Karen, being a lawyer from overseas, she has foreign income, but she has taxes up to date, and she also has a Canadian passport. So showing that the notice assessments were up to date, 2 years up to date, sorry, showing no income taxes owing in Canada was a green light for the reverse mortgage. So you shouldn't have any income taxes owing when it comes to a reverse mortgage. The second question is, can I be approved for a reverse mortgage with a dual citizenship? Again, this applied to Karen. And in Karen's case, she had a Canadian passport and she filed her income taxes in Canada, making her eligible for the reverse mortgage product. Again, the lender wants to see that you don't owe any income taxes. In that case, they may allow you to pay it off from the mortgage proceeds, depending on the amount you owe. So with them, they were excited about hearing the product and how much they can use their equity to fuel this construction cost as well as not having a monthly mortgage obligation. And they wanted to age in place. So as much as the younger sister works and lives in the Caribbean, she visits quite often to see her family and her other sisters. So this is a family home they wanted to maintain. So with the home equity release, there's no monthly mortgage payment obligation. And the home equity plan allows them to take out the entire funds to be dispersed to get started on the construction project immediately. In cases where if they went to another lender and applied for a construction mortgage loan, they would have draws, mortgage funds draws in stages to show that you're completing the project in a timely manner. However, with a reverse mortgage product, they disperse the entire funds to you so you can start on the construction project immediately, understanding that there's a lot of money in stake. The workers and the contractors ready to go. So once you have that money in place, you can start getting the work done immediately. So that removes the stress and anxiety for our clients that they got the funds immediately after closing and got working on the project right away. So this is another interesting case study to show that the reverse mortgage is be used in various ways. And these two case studies are just one in a million of different scenarios you can use it for. You can pay off debt. You can do construction costs, construction renovations. You can go for a trip. Again, this is a product designed for a certain age demographic where they're at a point of their lives that they're either retired or planning to retire, and they want that type of lifestyle of leisure and time spending with their loved ones. And in order to do that, you need access to funds and to supplement that type of lifestyle. So the reverse mortgage does have its misconceptions, but hopefully you can see in these two case studies that they can be utilized in various ways to increase your cash flow and also boost your vitality. Again, these are individuals at a certain age of their life. They're very vibrant individuals. People at this age still pick up hobbies. They do pickleball. They still travel around the world. So it's not like they're just at home, but we find that a lot of our clients have very different type of hobbies and activities to keep them alive. Like I was speaking to a client the other day, and for her, it's gardening and still doing a part-time job. In certain cases, our clients, or not even our clients, Canadians in that age range, over 70, are still working part-time so they can be around people and be social with other people, not just for income. It's more for the social activities to boost their vitality. So sorry, I went all over the place there, but this product is not just an income financial product, it's also a lifestyle product combined into it.
Thank you very much, Stefan. And I mean, we know we have we have a pretty aged population in Canada. There's a large percent of Canadians who are over the age of 55. And you are correct. I mean, many people, they want to age in place. That most people who have lived in a home where there's many memories, they don't want to leave that home when they are older. So many will make the home user friendly as their mobility slows down, if it slows down. But I've got a question for you. You know, as a as a um, as a former practicing mortgage broker, we know that many construction type projects go over budget. So in this case, where the clients took out their $140,000 with the inflation costs and escalating costs we've seen over the last year, if when they're halfway through their project or three-quarter way through their project, they realize that they need an additional $30,000. You did mention that they had no real savings. How flexible is the reverse mortgage lender in giving them the additional funds to complete the project? And will they use the current value of the property in its unrenovated state, or will they use the future value of the property in its renovated state to make their lending decision?
Yeah, that's a great question because it does apply to this case study where the clients did override their construction budget cost. And, it's a lot to take on doing a major construction costs, and it does come with certain construction cost override. In this case, they did have to borrow additional funds to cover the override of the construction costs, and the reverse mortgage lender they allow a second mortgage to go behind it under a certain type of guidelines, meaning it can't go past a certain annual percentage rate. The fees, meaning the cost of borrowing, the lender fee, the broker fee, and the legal fees, it can't surpass 65% of the completed value of the property. So there is some limitations when it comes to a second mortgage behind a reverse mortgage, but they do accept second mortgages in the cases where clients do have a shortfall. Again, it's based on your age and your property value and the property type. So it's a common occurrence when you're applying for a reverse mortgage. If you fall into those categories where you're below 70 years old, you may not be qualified for the entire mortgage amount that you need, but the lender will allow a second mortgage followed by the guidelines of the APR, which is the annual percentage rate, and the borrowing cost of the second mortgage that doesn't over exceed 65% of the completed as is value.
Okay, thank you very much, Stefan. There's a question here in the audience in our chat story. And this question is from Dr. Vibe. Dr. Vibe is the host of the Morning Vibe. It's a conversation that is had twice weekly online. He also shares a few other conversations on his platform, so you can visit the Dr. Vibe show either on Facebook or YouTube and see what he shares. The question he has is the $140,000 that Karen and Carrie borrowed, is that a debt that they incurred?
No, that's the construction costs for the property. So it costs $140,000 because they had to do excavation because they were actually making it 3 stories up. It was a 2-story property, so they're actually extending it higher up. So that was the cost of that was the amount that it cost to do the construction. The 20,
Okay.
yeah.
But would it be so they now have a mortgage for 140,000 plus any other mortgage they had previously?
That's correct. Yeah.
Okay, so they had a mortgage for $200,000 in their home, and you add the $140,000, their total mortgage is now $340,000.
Yeah, that's correct.
And that entire $340,000 is now a reverse mortgage with no payment obligation. Is
Yeah,
that correct?
That's correct. Yeah.
Now, some clarification. If the client wants to make a payment on that reverse mortgage, it's possible under the contract. And is the payment interest only?
Yeah, you can make a payment if you wish to, and it's interest only.
Okay. We have a question coming from one of our listeners. This is from Tricia. She says, I work with seniors. Their concerns are aging in their home gracefully. As they age and their lifestyle changes physically and they need care in their home, they're concerned about the cost to have quality care while aging at home. Is there a loan for health care while aging at home? But I think, Tricia, what Steph presented here is ideal for clients who want to age in place. They can use the equity in their home and fund the best quality healthcare in the later years of their life. Isn't that correct, Stefan?
Yeah, and that's one of the various ways that you can use the equity in your home to provide health in-home health care. As you mentioned, that we do have an aging demographic in Canada. A lot of senior Canadians are afraid to go back to retirement homes after the pandemic, so they prefer to age in place. However, you're aging in place, you may have some health concerns, and those costs can be quite heavily on you if you're on a fixed income or you're a retiree. So with the reverse mortgage, that can be another instrument you can use to use towards in-home health care. That's correct.
Thank you very much, Stefan. So I guess, Tricia, you actually either have a chat with Stefan. If you've got a lot of elderly clients, Steph has the product for your clients. Also, connecting with Andrew will also help because you can put the money in different vehicles so that your clients can have a quality retirement. Now, we're at 10 o'clock, and our conversation usually goes for 45 minutes. I mean, the 45 minutes went really quickly. If there are any other questions, you can put them in the chat quickly. I'm not too sure what the schedules for Steph and Drew is this morning, how much time they've got available for us, but we're willing to have another 5 minutes of questions. And if we don't, I would like to thank both Stefan and Andrew for their presentation. Thanks for introducing us to two products, one insurance, one mortgage, that are not, very common within our to many individuals. I was quite impressed with the case study that Andrew shared. I mean, we had a couple in their 50s with a mortgage-free home, no debt, and savings. As a mortgage professional for the last 25 years, that is a tremendous anomaly. Most people are burdened with debt, and most people have pretty large mortgages. So, I mean, they have to be in the top 5% of the Canadian population. And their incomes aren't significantly high. Their combined income is only $150,000. So, I mean, that was a very clear indication that is not what you make, but how you live. And they had children also who actually went to university, and I'm pretty sure they helped to fund their children's education also. So the case studies are outlining to us how we can prepare ourselves to retirement. I was a bank employee for a few years during the 90s. And the one thing I always heard the financial advisors from Wood Gundy say, who came into our branch, is that many people are under the misconception that you need less money when you retire. The opposite is true. You need a lot more money when you retire. If you're healthy and you retire in your 60s, you've got about 20 years of leisure ahead of you, traveling, golfing, dinners, theater. And if you're unhealthy, then you've got a lot of medical expenses that you have to cover. So either way, whether you're healthy or healthy, you need to have access to money. And one of the two ways to have access to money is by your home's equity that you can tap into through a reverse mortgage, or the right insurance product, which Andrew's introduced us to, which is the whole life insurance policy with a cash value which is called the infinite banking concept. So gentlemen, there's one last comment here, and then I want to thank you. Earl said great presentation and case studies. Thank you very much, Earl. Look forward to the next conversation where we would possibly speak about using the reverse mortgage and the insurance infinite banking concept to fund a health crisis. So we can show different scenarios, and we will welcome you again on the second Wednesday of April, sorry, I'm ahead of myself, as we share our next conversation with you. So thanks again for joining us for our morning money conversation with Steph and Drew. Everybody have a great day. And if you're not in an office, go out there and enjoy the first day of summer. Thanks a lot, folks. Stay
Thank
well.
you, everybody, for joining.
Thank you, everyone, for joining.
Thank you.